Hello, I would like to talk about a financial protection strategy using combination annuities for families with Down syndrome child. First, table of contents. I would like to go through the introduction of Down syndrome longevity risk. Then I will describe the model we're proposing as well as the assumptions and the constructions. By the end, I'll go through the results of the model and the conclusions and some of the future research directions we're going to go, as well as some of the reference. First, introduction to Down syndrome. There are approximately 400,000 people in the United States living with Down syndrome, and it is the most common genetic cause of intellectual disabilities. For the mother who are at age of 25, the likelihood of conceiving a Down syndrome child is 1 in 1,300. And as the age goes up, for example, as age of 35, the likelihood of conceiving a Down syndrome child increased to 1 in 350. Next, I'd like to talk about the longevity risk for the people who are living with Down syndrome. The life expectancy for the child who are living with Down syndrome increased dramatically from 10 years in 1960 to 47 years to 2007 to 60 years in 2015. This drastic increase in life expectancy was likely caused by several reasons. It could be improved medical care, could be better living conditions, as well as increased survival after corrective cardiac surgeries. Now, for the people who are living with Down syndrome, they have a special financial needs. A young adult in their mid-20s with Down syndrome, they exhibit a physical work capacity equivalent to a 60-year-old, and their daily living expense are actually higher than the people who does not have Down syndrome, could be due to less employment opportunity and extra healthcare costs. 2. Model description. I'm proposing a pre-funded contingent life annuity for the families with Down syndrome child. The way it works like this. The parents is going to pay in the premium when they are both alive. And if both parents dead before the child, then the child will receive benefit as a life annuity. Now, the premium payment pattern has two options. It could be pay until the first death or pay until both parents are deceased. And the benefit is the contingent life annuity. 3 is model assumptions. There are certain numbers or assumptions we have to assuming so that we can explore the insurability or validation of this particular model. We're using 2015 VBT mortality table, which is published by Society of Actuary. Then we also did some research on this widowhood effect. Based on the recent longitudinal study, there's extra 30 to 90% mortality was observed from the widowed individual compared with the marriage, which they are both alive in the first 3 months, and around 15% extra mortality if one of the parents dead, then the other one will experience. Therefore, we actually assumed a 15% widowhood effect for the parents. If one of them are dead, another one will realize the higher mortality. Then also there's interest rate we assumed built into this particular model. Although the interest rate is not a stochastic number, it's a deterministic, but we actually explored several different deterministic values so that we want to see how insurable this particular product is going to be. Model assumption. It is very important. The model assumption is the Down syndrome child's their mortality, because apparently Down syndrome child, although they are living much longer compared many years ago, but they are still relatively shorter than the people without the Down syndrome. So we defined a factor called the impairment factor based on the current pediatric studies, which shows that life expectancy for the Down syndrome child from 10 years to increased from 10 years to 60 years in the year of 2015. We define the impairment ratio as the following. It is the life expectancy for the individual with Down syndrome divided by the life expectancy for the healthy individuals, and that ratio will define as a impairment ratio. Now, for male is 74%, female 71%, in aggregate is roughly about 73%. With a impairment ratio defined, we want to calculate the impairment factor for every single age, the mortality, because the ratio is a definition for the ratio is the definition of life expectancy, but impairment factor is actually applies on top of the mortality for every single year. We have assumed impairment ratio, which is the life expectancy of a child with Down syndrome divided by the life expectancy of a child without Down syndrome. And with that, if we have assumed a consistent ratio among all ages, therefore, we are able, for any child with a Down syndrome, and based on this consistent ratio, as well as the life expectancy for the people without the Down syndrome, we're able to calculate the life expectancy for the child with Down syndrome. And through this formula, we're able to calculate the impairment factor for all ages, and therefore we have created a mortality table for the child with Down syndrome. Model construction. We have created a Markov chain Monte Carlo simulation based on triple life status, which is the healthy parents as well as a child with Down syndrome. And for this particular product, regardless of the parent's survival status, the death of the child with Down syndrome will terminate the life contingent benefit, life annuity benefit payment. Next one is model construction, the transition matrix. We have defined the status. Now, after this status, when we simulate what's going to happen with this family, and there's some transition mode in there, and based on this transition mode, the benefit or payment, the benefit or a premium is going to be triggered. For example, if the previous status is 1, which means all the father, mother, or child are all alive, and when it's simulated to go to status 7, which means the father is dead, mother is alive, and the child is dead, then in the beginning of the year, there's the premium is going to pay in because all the 3 people are alive, and by the end of the year, and there is going to be a death benefit paid to the mother because the child is dead and the mother is still alive. And based on this mechanism, and I'm proposing some of the baseline results. Well, first, the conclusion is the product is affordable because the premium right now is $175 per month for the family, and that is building on top of some baseline assumptions. For example, the mother and the father are the age of 35. I'm not using the age of 25 or a little bit younger age couples because age 35 is almost the trigger age, such that almost like a trigger age, such that it's more likely the parents will conceive a child with a Down syndrome. Next one, with some baseline results continued. Now this is really the distribution of all the premiums paid in, as well as the benefits, all the dollar from an insurance point of view, all the money paid out. As you can see, for the first 2 box plot is very condensed. What that means is most likely people are paying almost the same amount of money as the premium. However, the benefit portion varies a lot. Some of them are 0, some of it is a huge dollar amount paid out, and this is actually exactly what the insurance company or what the insurance mechanism should be, such that the payment portion is relatively stable, but the benefit portion it varies. Some family, if the child lives a long time, and they will receive a lot of money, but if some child is living a shorter time, they won't receive lots of benefits. Next one is a sensitivity test for the parent's age. The prevalence of the Down syndrome rose 31%, from 9 to 11.8 per 10,000 live births in the 10 representative U.S. regions. While this increase largely due to the woman conceiving after the age of 35. So women giving birth to child in their older ages is a trigger for the Down syndrome child's birth. Therefore, we want to test how sensitive this parent's age relative to this particular product. Turns out to be this factor is very significant for, as you can see from the table, for the parents who are 45 or older, the product is much more expensive compared with the parents who have a younger age. That's because when you have older parents and they have a child, and this child is going to live much longer, and the parents are in the older ages, they're much likely both of them are going to be deceased before the child. Therefore, that's the reason to make this product more expensive. Then there's the more sensitivity test for the child with Down syndrome, their age. And actually, when the child's age are older, it's the same thing as the parents' age are younger. Therefore, they are actually an equivalent to sensitivity test. However, there's some other external conditions and also some trending issues in there make this slightly not 100% equivalent. But in general, the shorter the gap between the age of the child and the parents, the affordable or the cheaper the product is going to be, because then the parents will more likely to taking care of their child for the rest of their life instead of both deceased before the child. Next one is the sensitivity test for the child death benefit. Apparently, the more death benefit and the more expensive this product is going to be. If the death benefit is 0, right now it's $2,000 annually, roughly $170 monthly. However, if you throw in some of this return premium or there's some fixed amount of death benefit, that will make the products more expensive. Surprisingly, if you return all the premiums the parents paid in, the product is not, it's still considered as profitable. It stays $2,000 or roughly $3,000 annually. Then the next sensitivity test is the premium payment pattern. We have explored two options. Number one is the premium payment until the first death. The second one is until the second death. The first death is once this family become a single family, single parent family, then they stop payment. Then there is a gap. When both people are alive, when both parents are alive, payments there is going to be payment. And if one parent is dead before the child, then there is no payment as well as there is no benefit either. Then if both parents dead before the child, then there is a life annuity provided to the child. That's one option. The other option is the premium pay until the second death. As long as one of the parents is still alive, they're going to continue to pay in the premium. And obviously, the second one, there's more money going to be collected in terms of the insurance perspective. Therefore, this particular product is going to be much cheaper than the first one. The last one is a sensitivity test for the interest rate. Currently, the baseline I'm using for this sensitivity test is 2%, which is reflect the current low interest rate environment. And then the annual premium is $2,000 annually. But in case of the interest rate increased to some other number, for example 5%, now the premium dropped down to $400 annually, which is less than $50 per month. Now interest rate is a very significant factor for this particular product, is because we are looking for the benefit paid out in the future. Therefore, this time value of money works favorably for the families who are purchasing this product. In the end, there are approximately 400,000 people in the United States live with Down syndrome, and there are around 6,000 newborns are diagnosed with Down syndrome annually. It's such a large population. The financial consequence when an individual with Down syndrome loses both parents are significant, and the need for the financial support becomes critical. And the financial vehicle we're trying to explore is trying to cover the longevity risk. And this risk becomes much more real and in the future is because with the parents are conceiving babies in the older age, as well as the child with Down syndrome live longer, then they will have this their longevity risks become more and more significant. And after exploring this product, it is insurable with very minimum self-selection and with risks that can be validated and modeled. And the premium cost is relatively small compared with potential benefits. Constructing the model, we have studied in depth the pediatric and public health literature related to Down syndrome. It is really the combination of actuarial work as well as the pediatric and public health work. The research, in the future, we're also thinking that this research can be expanded to other intellectual disabilities such as Alzheimer's. And for the most people with the intellectual disabilities, longevity risk protection is significant because they may be in a very sound health otherwise. The purpose of this study is not trying to only show this is a profitable product, then all the insurance companies should flood it in and make money out of the families with Down syndrome child. Instead, I want to encourage more researches related to families with Down syndrome child, as well as more resources allocated to this area from either the government or private entities of the society. And I believe and maybe the government could spend a little money such that it can provide a good support, a sound financial support to the family with Down syndrome. Also, I want to have a special thanks to all these scholars who have wonderful resources and have supported this study. Thank you.